Hey everybody, this is Jose Blasco. We are about to get started. As always, before we start, sound check. Quick message on the chat box. We'd do very well to confirm that you hear me and sound is good. All should be okay, but as always, it's very appreciated to have a quick hello on the chat box. It's a nice thing to do, isn't it? And on top of that, it confirms sound is good. So please go ahead and give me that quick message. If that's okay, I'll turn on my video stream so I can say hello from here, from the bottom right side of the corner as always. And ready to begin our last session of the year. My friends, 2021 almost over. How are you, Joe? Good to see you. Very nice. 10 seconds to go and we will be starting the session. Here we go. Almost there. Cool. Top of the hour. Let's begin. Welcome to the session, everybody. This is Options with Options. My name is Jose Blasco. December 30, 2021. Last session of the year. Obviously, we're going to trade options. Before we get started, disclaimer, please read it carefully. It's on the upper left side of the screen. Read it with no rush. Read it completely. It's important information, so I'm counting on you to do that. And as we complete the disclaimer, as I was saying, today we're going to be obviously trading options. The name of the session says it all. And the process that we follow, if you are new to our sessions, is we basically look at the market first. We look at trades that we have in process, and we talk about things such as trade management if needed. And from there, we look at new trades, new executions, new opportunities, and we spend time talking about all the various parameters related to options trading to have our trades positioned in a way that is optimal. Okay, Mark, how are you? Good morning, my friend. Yeah, happy New Year. Incredible. Where did 2021 go, isn't it? Christian, good to see you as well in the session. Happy New Year to you as well, my friend. Very nice. Okay, so a quick reminder, we have a special link which is very useful, tradewithufos.com/Jose. Could also be slash Reynaldo, slash Becky, slash Boyan, any of your instructors really. And you come to the page of the instructor. And even though you come to the page of the instructor, really, when you look at the question section, that one is generic and applies to all asset classes, all instructors, all sessions, all courses, all apps, all everything. So if you have any question, this is the perfect place for you to come in here. You click on the purple button, you log in, and the moment you log in, then you click on the green button, and then you can ask your question. I would recommend that you search for your question first, because maybe the question has been asked before and the answer is already waiting for you, which is why this is cool. It's helping the community, if you wish, because it becomes like a knowledge base, a smart knowledge base, I should say, because those questions are very good and the answers hopefully as well. Okay, cool. So with that said, let's now move into top and begin our session. We're going to move to SPY and we're going to begin the analysis. Leland, good to see you, my friend. Happy New Year. And Mark, I understand that TradeStation has not corrected your feed yet. I am not surprised of that. We actually even had some delays with clients' activations with TradeStation. Our users that use top connected to TradeStation require TradeStation to do a data line activation, as some of you probably know. There's been some delays with some of our clients, and obviously the dates are the reason. Okay, so I guess that TradeStation is a bit understaffed at this moment in time, given the holidays, and there are certain things that may not be as critical to them, even though it is to us. And they are doing what they're doing. So I would say, Mark, just be a bit more patient, because really going back to normal, January 3 is around the corner, and everything should go back to normal at that time. Okay, so the S&P, what's going on? Well, we are up 0.15%. So that's obviously nothing magical. It's just a little bit move up that could change anytime. It's not a surprise either, because we're in an up climate. 6 candles out of what statistics would say 5 is the normal thing. So that climate now is starting to enter the territory of what we call hopeful. Another way to think about it is tired. Statistically speaking, it's now surpassing the normal duration, which is 5. Okay, so that obviously increases the risk for the market to correct and go back down. On the other hand, something that was not happening yesterday is happening today, which is, as an average, the implied volatility of the calls surpasses the implied volatility of the puts, which is a bullish component. Okay, which may be a little bit of a prediction of what may happen on January 3. Even though I'm not saying this for you guys to, I'm sure you're not thinking about it, but I just need to say for everybody to be safe, just because we get to see a little bit of higher implied volatility on the call side and the put side, and that may indicate a bullish sentiment building up, and therefore maybe a gap up on January 3. Obviously, make sure that if you want to take a trade that benefits from that, you don't bet everything on it. Okay, so to take a proper trade, you need to have more elements that are part of your trade plan, such as the UFOs, the climate, etc. But again, it's indeed something that is happening as we speak. 1.7 times more calls than puts, 1.4. And then when you get into January 7, maybe a bit more uncertainty there, with the put volume reaching its average, not the call, where on the shorter expiration date, the call volume is reaching its average. So it seems that there is a little bit of a fight. It seems that short term, there is a bullish sentiment, happening. The real-time implied volatility for the calls is 13 versus 12. That's not the average, that's the real time. And therefore, all of this is indicating that this may continue a bit longer, even though statistics on the auto climate is suggesting that cannot last for much longer. But from behind the scenes, there is more bullishness building up. So we'll see what happens. And by the way, this could change. Okay, you saw how yesterday when we were in the session, the puts were winning. But notice how at the end of the day yesterday, if I go back here, so basically the implied volatility of calls and puts equalized to 11. Okay, there was no difference anymore, and now today the calls are winning. So this could change before the end of the session. Okay, obviously, and it's something for you to monitor. But definitely, my perception would be that this may continue just a bit more. Probably until January 3, and then anything could happen really, even beyond auto climate, because it's such a big event when we have the first trading day of the year, right? So because the large market players, they start positioning themselves for whatever they believe the year is going to be, and it's kind of like an event, just as relevant as an earnings report, where who knows what's going to happen. You may expect a gap, who knows if it's going to be up or down, who knows what the result of the report is going to be, who knows what the interpretation of the report will be. Even if you knew the results ahead of time, what's the market going to interpret out of a fundamental number? So beginning of the year, first trading day of the year is a bit like that too. Okay, so very difficult to predict, and not a fan in my case to do that. I prefer to take trades every day of the year instead of having this big bet on one day in the year. And if I'm right, it makes me so proud. But then what about the other 251 trading days, right? So I'm again not a fan of that, but sharing with you guys. So when you see it happen, Mark, maybe do an end of year trade and SPL TLT. Yeah, well, Mark, I just said I'm not a fan of that. So I mean, if you guys are very interested, we can get a bit creative on putting something together that would benefit from a gap. But again, yeah, even if it does, it's just going to be a few pennies, and if it doesn't work well, you cannot recover from that trade until next year when you do it again, right? So I just prefer to do my regular trades throughout the whole year. Okay, and it's just being careful that January 3 is a big event, just like you would be careful that when an earnings report is about to be reported, you would just be careful in front of that. Yeah, the 480 calls with good open interest. I hear you. I hear you, Joe. Got it. Perfect. Okay, so let's continue, everybody. Okay, so let's continue. So we have the VIX. We have the S&P. We talked about it. Let's talk about the VIX. Okay, so the VIX is currently trading at 1695. Is going lower even more. Okay, why? Well, obviously, the S&P is going higher. The call side is winning versus the put side. So that bullish sentiment that is building up, when you do the math and you analyze the implied volatility of the 500 stocks that make up for the 500 index, the S&P 500 index, which is the VIX, So then this translates on the VIX going down by a certain amount. Okay, so not a surprise. And therefore, the plan for today really when it comes to trading is exactly the same as yesterday. So long trades would be preferred, given the fact the climate is up and everything we just discussed. But at the same time, today we have potentially there's risk because the call implied volatility is above the put, but still the climate is reaching its end. Okay, and also as I pointed yesterday, the max distance reached 146, where 0.74 it's the 2 standard deviation normal value. In other words, that climate, that move is what we call too far too fast. We talked about this yesterday, and the climate is getting tired. So all of this obviously doesn't give me just peace of mind for me to just go long, 20 trades at a time, long all of them, and that's it. No, the idea would be for every long, get into some sort of a hedge with shorts, okay? And depending on your risk management philosophies and so on, you may want to get more or less deltas, either positive or negative. But indeed, don't go long only, and definitely don't go short heavily because the climate is up, okay? So that's the plan, and that's what we're gonna do, okay? When it comes to reviewing positions, well, we have COF, so and Yelp. So speed of the light with COF and Yelp. So COF is up by 0.74% today. Again, even though it's up overall, if you look at the chart when we plan this trade, okay, it's, we entered on that day and it's way below. Okay, so good news, thanks to the tweaks that we have been doing. So this trade, it's currently making $59.5 and we'll probably end up with that amount. So not amazing, but not a concern either. Okay, we cannot lose on this trade. We talked about this yesterday. Yelp, quick review one more time. So Yelp is up by 2% today. Okay, so that's much more interesting. Okay, because now we are getting closer to, if I go back to the intraday time frame that we used. Okay, yeah, so we are now trading at 37.29, so we are getting closer to that area at 38.5, which was our entry. Our entry was this crossover right here. That was our entry. So what's happening to the P&L of Yelp? We are currently on the water by $33, where if you think about it, it's pretty okay given everything this trade had to suffer. So it's pretty okay, even though we need Yelp to continue going higher a bit more for us to start getting into the green territory. Good news, expiration is February, so we have time for this to happen, especially if on beginning of January, we're going to have a push to the upside, okay? And PHM, actually, that one I need to delete because we closed that trade yesterday, isn't it? So we are just going to delete it, and that trade is over. So done with the review, done with the market analysis, and therefore it's now time to look for new trades, okay? So where is my matrix? Is here. So here's the matrix, okay? So let's go ahead and again do the scanning process properly. By the way, one quick one here, guys. One very quick one. Let me go back to top. SPG, okay? Yesterday we were talking about SPG. I was expecting SPG to come back down. I believe we were looking at the 233-minute time frame, if I'm not mistaken. There were red UFOs there, and we were expecting those red UFOs to slow down the move up and bring it down just by a bit. So that way our entry price that was 20 something cents yesterday could potentially become free, right? Zero. But unfortunately, that stock, as you can see here, has been rallying 1% up, and therefore instead of 25 cents, actually now it's 50 cents. In other words, if we had entered yesterday, we would be making $25. But again, that was not the plan. I wanted to enter at no cost. Okay, so I missed my fill, and that's what it is. That's trading. Sometimes you get a winner, sometimes you get a loss, sometimes you miss a trade, and that's the case yesterday. I was keen to give the trade an opportunity, to give them the price I wanted, but I didn't want to enter this trade and getting into a debit instead of a credit, especially with the disadvantage of having only $5 strike price increments. Minimum risk was $500 per contract, etc. So I just wanted to have a neat entry, and I didn't have the opportunity. Okay, so I'm just gonna pass on this trade and start fresh when it comes to planning new trades. Okay, so let's begin. In my analysis of new trades, the first thing I'm gonna do is I'm looking for top positive CIV spread. So I'm looking for long first. Second scan, for now we're gonna leave it as known. Okay. We'll come back in a minute later. Later, as always, I will use scan number 2 to look for cheap options, but not now. Number 3, stock filters. So we want the group to be strong in those long terms. Okay. We want the scan list. I got my list there. Of course, if you uncheck that, you're gonna have so many more opportunities. Okay, but I like to use my list, which probably a majority of you know. It's a list that I call the penny increment options. It's a list that I utilize. I extract that list from the platform Thinkorswim, because they maintain that list for years and years, and I've been using that for years and years. It's not every single symbol there will be liquid enough at times, but the majority are pretty okay. And then when it comes to negotiating your entry price between the bid and the ask, you can do it in pennies, which often helps to get better prices. Elliott wave and strength, we leave it alone, earning at least 30 days out, so we can get some move before we reach earnings. And finally, auto climate. So in a perfect world, you would want the daily to be confirmed and sensible. You would want the weekly to be confirmed and early. Okay, and you want on the daily to be near the 9 EMA. So that's the perfect world. Let me see if we have something perfect. We don't, because it's obviously too demanding. So next step will be to uncheck near 9 EMA. And now we got 3 possibilities. So SPG is still there, but I would say we missed it. We have Lennar Corporation. We also have Mosaic Company. So let's start with Lennar Corporation. I am now loading the chart, and let's begin our analysis. Okay, so when it comes to Lennar Corporation, notice how we are in an up climate, 5 out of 7. Implied volatility for the calls as an average is above the puts. So all of this is giving us a green light for us to plan a trade and go long. Little note of caution here, which is that we got an early wave turning point, and we are getting close to what the target would be. Okay, so in that sense, I would not suggest to have a target, pointing at the moon. Let me see what happens if we project our speed bumps from there. Yeah, and the speed bump is falling into that area, but definitely since the area begins way lower. So in this case, I would set a target to be 121.31. Okay, so that would be the plan. I will not go for a higher target because that is deep inside the Elliott wave target area. Okay, so so I got the implied volatility of the calls allowing me to do the trade, the climate allowing me to do the trade. The target seems to be, let's say, far enough, within an Elliott wave, and that may be redundant to say it like that. So all of this is good. We know the stock belongs to a strong group, all of those things, but we have a problem. And here we go, Joe, I love it. Your eyes are very well trained. Probability for the UFOs on the 55-minute time frame is only 42%. That is not acceptable. On top of that, we need UFOs located around 113, okay, 113.29, which is below that 113.94. Is below. So that UFO doesn't work because its probability is too low. On top of that, that UFO is almost well located, but not well located enough. So then we're gonna have to explore what happens with other time frames, and therefore I am moving from the 55 to the 89-minute time frame to see if we got something better. We got another UFO there that maybe it could be, but again, 44.95 is less than 50, so we are not gonna accept it. So I'm gonna check the 144, which provide 53%. That's great, but the UFO is way lower at 109, so that's not good. And then I'm gonna try the 233. And see if that one would work. This is the one that worked yesterday with SPG. So let's see with Lennar. And no, it wouldn't. The UFO is in the right place indeed, but it's 48% only instead of 50. Okay, so with intraday time frames, I cannot find the type of entry I need. So then I'm moving to all the way to the daily time frame. And by using the daily time frame, to be honest, it was a simple setup. Now I got what I wanted. I got this very big UFO from 115 to 111, providing 52% probabilities. Okay, and therefore that UFO it's indeed valid for me to rely on it to take the trade. Okay, now 115.11 is my desired entry price. The current price of that stock is 115.84. Okay, so I got two choices: wait for price to retrace a little bit and then build a spread, okay, and catch it from there, or instead do the same type of thing I did yesterday with SPG, which is, hey, I want to buy a call, but for me to buy the call, what I'm going to do is I'm going to sell a bull put spread, which is going to create a credit, which is going to pay for the call. Okay, and this is indeed a valid way to approach it, and I am going to be doing that. Okay, I'm going to be doing that. By the way, notice that when I was looking at the matrix, I didn't check for low implied volatility, okay, which I would care. How are you, Joanne? I would care if I was to build a spread, because if you build a spread, you want the options. I mean, a debit spread, right? A bull call spread. You want the options to be underpriced, or at least not overpriced. But in this case, I am not building a spread. What I'm building is I'm just buying a call and I'm financing the call by selling a bull put spread. So as long as I'm looking at the option chain, I find strikes that pay me enough to do this trade efficiently, so that's good enough. And therefore, in this case, I don't even care about the implied volatility, even though, of course, I would have more advantages, if the implied volatility was a certain level. But because I only have three choices, so it doesn't even, bother me to go ahead and do that. Okay. Cool. So therefore, let's look at the option chain. Okay, and first let's see the expiration dates available. In this case, we have multiple dates available, and we have strike price increments $1 at a time. So assuming premiums are good, we should be able to do something pretty okay. Okay, we should be able to do something pretty okay. I sense a little bit of lack of liquidity on the weeklies. What about the monthlies? Well, it's about the same. Yeah, it's about the same. Yeah, not the most liquid stock in the world, but it's indeed tradable. Okay, so okay, great. So let's go for this. So we said the target was going to be around 121.5. Okay, that's the location for the target, 121.5. So if 121.5 is going to be my target, somewhere here. So the question is, how long is it going to take to get there, assuming I'm right? For that, we use a strategy builder, which is giving me the target date, which is January 24. Okay. Now, because it's January 24, focusing on the January 21st expiration I was looking at earlier is not ideal, because if that stock doesn't move as fast as expected, then next thing you know, while I may reach my target, the options may expire ahead of time. So I would like to observe expiration dates beyond January 21st. Okay, January 21st is not good enough, and that bothers me a little bit because it gets me into the weeklies, which may be a bit less liquid. So I'm gonna have to take a look and see what's best. Okay, this may require me to go a bit back and forth, because again, we are not dealing with a stock like Microsoft or the S&P ETF, which is so crazy liquid, which doesn't matter which expiration date you use, it's all good. In this case, I may need to select or sacrifice some strikes or some expiration date to get less slippage on the trade. Okay, so we're gonna see that. But also, before I get there, I want to take a look at the skew. Okay, I want to take a look at the skew. We said we were going to use January 28, February 4, February 11, and February 18. So we're going to be looking at those strikes. And I would like to load calls and put both. And I would like to, okay, 10 strikes. That should be good enough. So let's see what we have there. Okay, so let's see what we have. So, okay, great. So here's what I'm looking to do. Okay, and definitely I can see how the orange one, the February may provide the least advantage of all. So I'm just gonna remove it, and also it's gonna help me understand that much better. So basically what I'm looking for here is I'm looking for a line going down as we go to the right. Why? Because I want the implied volatility of the calls, which I'm gonna buy at a higher price. I want that implied volatility to be less compared to the implied volatility of the puts, which I'm gonna sell using a lower price. Okay, lower prices are on the left, higher prices are on the right. So because I want the call to be less inflated in volatility, I want this to go down. And notice how it's looking like it's all going down, even though the light blue one, which is February 4, has some price anomalies where certain calls are super crazy expensive. Also, notice how the dotted line is the put and the solid line is the call. Okay. So some of those calls are very expensive, okay? Where with the January 28, which is the magenta line, it seems that those calls are the cheapest, and the magenta values there are pretty high, in the same line as February 9, just less high than February 11, but the problem with the February 11 is that the calls are much higher. Okay, so in other words, right now it seems, at least up to this point, it seems that the January 28 is probably the best combination to do this trade, given the angle and given the fact that the puts are higher and the calls are lower compared to the other expiration date. So that's going to be the expiration date I'm going to use, because probably it's going to give me the best advantage. Now, I may need to change my plan in the end, because maybe if January 28 has too much slippage, so then that's just gonna kill me, and that's it. And then I'm just gonna have to see what else I can find. That's options trading, right? Options give you options. That's good and that's bad, in the sense that it's very good because you can do many things. Sometimes it's bad because what you want to do, you cannot do it. You have to do something else. Okay, so anyway, pros and cons, like many things in life. So January 28 again is gonna be my initial choice because of everything I said. Let me load more strikes. Okay, and then before I start looking for the strikes I want and so on, I want to go back to the chart very quickly one more time and just say something I said yesterday when I was planning the trade on SPG, which is, remember, the trade was, one more time, buy a call, and in order to buy the call, you were selling a put and buying a put. But if you recall, yesterday I reminded you that we have done many times this type of trade, but instead of selling one put, we sold two puts and bought two puts. Okay. And when did we do that? Well, we did that in trades where the climate was down, where price was crashing like that, probably inside of some sort of a speed bump, and we were trying to catch the trend reversal. Okay. So now you are more likely or more easily going to be wrong if you are basically getting into a stock that is falling, versus if you are getting into a stock which is, with a defined climate, confirmed climate, belong to a strong industry, all of those things, right? So in that sense, when you are doing a trade with a stock which is falling so much like that, like we have done in the past, so typically what we do is, I would be looking at those UFOs below, and that's the place where I would be selling two puts and buy two puts. In other words, those UFOs are far away, and because they are far away, they pay you little. Those puts are out of the money, they pay you little. So then to be able to buy a decent call, you have to sell double. Okay, but in this case, I'm not going to sell double. I'm going to do it with one. Why? Because the UFO I'm going to look for is the one which is right there, the nearest one. Why? Because we are in a scenario where we have a defined climate, define everything. It's just like, we are, instead of waiting for price to come to the UFO and then take the trade, because that may not happen, because actually this already happened if you look carefully. So that current candle today already went to the UFO and bounced out of the UFO. So we missed it. So it may come back again or may never come back again. We don't know. So in order to not to miss the trade, we're going to play this particular move, which is selling a bull put spread to buy for a call. Okay, selling a bull put spread so we can buy a call which is paid by the bull put spread. So therefore, 115 is the strike I'm going to be selling, which is right here. And if I sell that, I'm going to get paid 310. Okay, so 310 is what I'm going to get paid. Okay, now initially what I would like to do is sell the 310 and buy the 295. Okay, that's the nearest one. Let me edit this, all January 28th. And if we were to do that, we get a credit of 45 cents. So with a credit of 45 cents, this is not going to be good enough because we're going to end up buying an option which is very far away. So with 45 cents, we could buy this one, okay, like the 127. So if we buy the 127, that one, okay, so now we end up with a debit of 0.003, so it costs 3 cents. But notice how the delta provided is only 0.15. Remember, our target was 121. Our target is 121. So in other words, if I end up, okay, making 127, okay, sorry, let me rephrase that. If I end up buying the 127, the day you reach the target, that 127 strike is going to be indeed by a lot out of the money. So that option is being really hurt on time decay, and is not really providing much deltas, only 10 deltas. Okay, so that's not a setup I like, and the reason why this setup is not working well is because, you know, I'm just selling 115, 114, so I'm only taking $100 of risk, and that's very, very little. Okay, that's very, very little, and therefore it's not working well. So what else can I do? I can increase my risk to maybe a couple hundred more dollars. So if I sell the 115, buy the 112, this now will provide $300 of risk, okay, but will also provide $122 of credit. And if I do 122, so that allows me to buy the 122 right here. Okay, this allows me to buy that. And if I was to do this, that's going to be much better because now I have a delta of 38. It's gonna cost me 5 cents. Okay, so it's not a $0 trade. It's 5 cents, $5. But now I got a much better delta that, at least this makes a bit more sense. Okay. In any case, still, when reaching your target, it's not like this is the end of the world, but I prefer to look at it differently. When reaching the target, the 122 strike will still be out of the money by 50 cents. Remember, the target was 121.5. So if your target is 121.5, when you reach 120 and the option you use is the 122 strike, that one will be out of the money all the time, even when you reach the target. So that's not ideal because, again, time decay will hurt that option more. Okay, so I'd really like to use the 121, and it seems that the only way to use the 121 would be to increase my risk a bit more, another $100. Okay, and this may allow me to buy the 121. Let's see, exactly at $0. Okay, now of course the risk of the trade is 400 because from 115 to 111 you got $400 of risk. Okay, but now if you get to the target, you're going to benefit from that at a rate of 45 delta. So how would that look like on a risk graph? Okay, so this is going to be one initial approach. Okay, so if you get to 121.5, somewhere here. Okay, so then you would make $48 if you reach on the expiration date. Okay, or we said it was going to be 122, right? 122 was going to be the target date. So again, 121.5. Here we go. On 122, we would expect to make $175. So this is the trade. And let me comment on pros and cons and different connotations for us to take into consideration. So first of all, if you think about how much you can risk, which is 400, versus how much you're going to make, which is 175, your initial thought may be, wow, that's not amazing. Okay, that's not amazing. I prefer to pass because the reward to risk ratio is not too good. And in one hand, I'm totally with you. On the other hand, remember, the moment that stock is gonna work, it's gonna move. We're gonna close the puts. We're gonna sell a call against the call. So we're gonna improve that so much better if we are right, where the profitability should be better. Um, of course, with options and all the moving components, such as implied volatility, such as time to expiration, such as interest rates. So then it's impossible to predict everything, to the teeth. And therefore, you would not know exactly what the net performance will be at the end, but certainly better than that. So I have no problem of doing this type of trade, um, especially given the fact that the benefit of it is also the fact that I don't need to wait for price to come back into a UFO, because it may or it may not, and then I miss the trade. So then I totally missed the profit, right? So this trade is a trade that I would accept. I'm not crazy about it, but I would accept. Okay, so that's trade number one that I'm gonna put out there. Okay, but at the same time, I also sense. Okay, let's take a look at the implied volatility here. So if we look at the implied volatility for the stock is quite low. Okay, it's quite low, and this is very good when you're building spreads, but it's not that good when you are trying to sell a bull put spread to pay for a call, because the bull put spread you're selling is not paying you that much. Okay, even though thanks to the skew tool we used January 28, which is likely going to be the expiration date, giving you the best result there. But still, the implied volatility is, as you can see, is very low compared to, it's been up to 45 and now it's 28. So what's another possibility? Well, another possibility would be to just keep it even simpler than that, and just let, as we have done before. Okay, that is something I really enjoy doing, especially with stocks where you don't have this amazing liquidity in all expiration dates, and you have limited options. So I love to use the strategy builder. Okay, so let me do that, because sometimes the strategy builder will uncover some trade that gives you a better performance compared to what you would have found by yourself. Okay, and in this case, so we have a bull call spread there. Okay, so if I was to look at the bull call spread, well, it's obvious. If the market goes up, you make money. If the market goes down, you lose. But the beauty here is that high the risk graph. The beauty here with this bull call spread that was planned for us is that the most you will risk is 140, where the maximum profit you will make is 360. Now, 360 doesn't mean you're going to make 360. Okay, that's the max profit of the trade. Okay, so that's if you reach the target on a very specific date. So that's, and there is, many factors acting there, including luck. Okay, so what if we look at January 23 is the expected. Here we go. January 23 is the expected target date. So if we do that, and I look at 121.5, so how much are we going to make? So it seems that we're going to make around $80. Okay, so we are risking 140 to make 80. Okay, so you can see that the column of max profit in this case does not apply. Okay, so what would I do in a case like this? Well, my focus then would be on credit trades exclusively. Okay, only credit trades, such as this bull put spread. The bull put spread between made of selling the 120 put and selling the 115. Again, notice how this bull put spread is a bull put spread where we sell options that are in the money. This is an application of trading bull put spreads, which is very directional. It's not the classical way on how to do a bull put spread. We talked about this before. This is a bull put spread with 15 delta. Many of the bull put spreads that are being done by Credit traders are very low delta because they are basically betting on the stock not going somewhere. In this case, we are betting on the stock to reach 121.5. And the beauty is that if the stock reaches 121.5, actually, even if it doesn't, as long as the stock is above 120 on expiration date, you will make your maximum profit, which is 275. Okay, 275. If the stock went against you, so the risk of the trade will be 225. So the initial relationship between risk and reward in this case is better. Okay, in this case is better. And it probably has to do with the fact that while the implied volatility of the stock overall is quite low, there is a bit more premium on the February expiration date that what we had on January 28. Now, if you recall, when we looked at the skew, and I look at February 18, orange color, so the calls are very expensive as you go up. The calls are becoming very expensive. So I would not want to do the same trade I did with January 28. Okay, the January 28 trade of selling the 115, buying the 111, and then buying the 121. I would not want to do that with the February because I know the calls are going to be crazy expensive, so it's not going to work too well for me. So I'm not going to do that. But just doing the bull put spread version of it using February 18, and instead of doing a bull put spread below price, doing a bull put spread above price, so that makes sense. Okay, now you do need to be above 117.25. Okay, the current price of the stock is 115. So we need that stock to rally for us to profit. It's not a classical bull put spread where even if the stock stays the same, you profit. You need the stock to rally for you to profit. Does that make sense? So that's to be kept in mind. Okay, I'm just kind of repeating myself because this is not a normal or classical applications of bull put spreads among the vast majority of credit traders in the world. Typically, credit traders are selling bull put spreads in places where they think the market is not going, and they make money out of time passing as the stock stays the same, goes in the opposite direction, or if it goes against the trader, not too much. In this case, we are purely directional. We need the stock to rally at least above 117.25 for us to make some money. And ideally above 120, now we make full profit. So this trade seems a better choice in this case. Also, this is not the most liquid stock in the world, so I'm also thinking about it from the point of view of now I got one contract less, and therefore potential for slippage is going to be one contract less. So all of this works in my benefit. Also, it's a monthly expiration date, February 18, versus a weekly expiration date, which we saw earlier in the option chain that the monthly is just a little bit more liquid, not too much more liquid, but just a bit more. Okay, so in that sense, that would be my choice to do this particular trade, and we're gonna put it in. Again, the initial risk of the trade is, as you can see, $225 per contract. And then, of course, in future sessions, we'll be working on the trade, on what to do to offset the problem if the stock goes against us, etc., etc., etc. We're not going to leave it like that. We will obviously be on top of it to try to embellish it more throughout its life. Okay, but that's the whole. I'm just sharing, all my thoughts there, and hopefully it's not too much, it's not confusing. And now you know what I'm thinking when I'm looking at all this market data and why I'm going to take this trade. Joe, you just did that with EL. Okay. I have never traded that stock, EL. So you're talking about EL stock, or you're not talking about easy language, right? Which is a programming language. I mean, this is silly for me to ask, but just in case I misunderstand, I rather have a silly question instead of closing the session and I never understood what you said. Okay, so that's why I'm asking. Thank you, Joanne. A still order. Okay, got it. Perfect. Got you, my friend. Yeah, I have never traded that stock, and so not in my radar. But yeah, definitely a good approach, my friend. So let's go for it. Let's put the order in. I want to get rid of the January 28 combination. We're not going to do that. We're just going to do simpler bull put spread using February 18. Here is TOS. Here is here we go. We said February 18, good, and we said we are selling the 120 and we are buying the 115. Okay, so let me review if that is correct. Float the risk graph, go back to thinkorswim, get the risk graph on top of thinkorswim so I can compare and make sure everything is right. So we are looking at February 18, looking at February 18, we are looking at selling the 120 put and buying the 115. We are looking at selling the 120 minus sign minus 1, and we are buying plus sign the 115. This is correct. 275 is the expected credit. Right now, real time, it's supposed to be 280. So I'm going to try very quickly to see if I can get 280. And if I don't, I'll move it down. Okay. But my order is in. Okay, marked 275. Yeah, so I'll just wait a little bit to see if I get filled. And if I don't, I will change it. Okay, got it. Perfect. Okay, so let me do some additional notes on the chart so we can track this trade in the future. So we are doing this trade on this particular day, on this particular price. Okay, so this is the day we took the trade, and now let it play out. Perfect. Questions, everybody? How is it going? We're gonna go for another one. Okay, let me know. I'll be looking at the chat box in just a moment. Okay, now let's go back to the matrix. Quick one here to replace the order at 275, see if I get filled. And we'll see. So back to the matrix. Okay, so what else do we have? We also had mosaic. Okay, so let's take a look at mosaic. Okay, so when it comes to mosaic, yeah, well, actually that's not good anymore because it's 6 out of 5, so that will not be good. So in that sense, I would prefer to pass on this one. Good. So now what else? Let's say you need more trades, right? So what else can you do? So what about we make the weekly to be sensible instead of early? This may increase the list. Yes, it does. So let's take a look at what if something is near the EMA now? Nothing. Okay. Being near the EMA, it's gonna be a rare case, but obviously it's very ideal. Okay. You are in market 285. You have the order in at 285 for a few minutes. Okay, got it. I mean, 280 was the normal thing. Right now, it shows. I believe I closed it, isn't it? Yes. Oh, yes, I had it grouped. Silly me. I had it grouped. Silly me. So yeah, so I'll come back to it in a moment. But yeah, it was 280. So yeah, not the one we want. Okay, so what do we have here? LEN, MOS, SPG is the same. So we have Qualcomm and DHI. Okay, so let's take a look at DHI. Okay, so DHI. So let's see what we have. We have 5 out of 7 calls above the puts. This is good. Yep. All of this is good. And what about Qualcomm? Oh, NVIDIA also showed up. Okay, NVIDIA also showed up. What about Qualcomm? So Qualcomm is 5 out of 6 call above the puts, and we are actually nearer to the EMA here, so I'm tempted to work on this one instead. We may have a better entry. Let's take a look. So on the 55-minute time frame, we have very good stats. Okay. If we go back a few candles, no, at the beginning of the day we didn't have any UFO. So yeah, so yeah, good stats but no UFO. So we need to move to 89. So switching to the 89-minute time frame. No UFO. So what about 144? Yes, so we have UFOs and we have 55% probability. Those UFOs are located at 183.71, which coincides beautifully with the EMA. Okay, so we have a setup here that we can enter, and basically same story. So the price is a little bit above the UFO. So in a perfect world, you wait for price to come inside, and then you do just like a regular spread. And this is normally when you get the best reward to risk ratio of all. But another option with options is to take the trade when you're still outside the zone. So in case it doesn't come back and it just keeps going, so you don't miss it. Okay. So let's get to see what's possible here. Okay. And in this case here, I feel the implied volatility is a bit higher compared to in the other case. So here we may have a little bit of a better combination compared to the other case. Before we do that, very quick, I just want to see if I'm being filled or not. I am not being filled, and I want to get filled, so that way I can review all of those things for you next year. So I'm dropping this to 270, and I just got filled. Okay, so now I got filled. So let me input this trade. In here, just give me 1 second, guys, because since I closed it earlier, so we're selling the 120 and buying the 115. Okay, and the prices we got are, so for the 120 that we sold, we've got 720 and 450. Okay, so 720 and 450. I'm gonna click OK. So this is the trade we did, and now I'm just gonna copy these to the positions. So then into next year we can talk about it, okay, and we can learn more about its management and the various possibilities available. Field at 275, very good mark. Your 55 UFO is at 15% calibration is 0.618. Me too, but that probably means that we are using a different quantity of candles on the chart. I am using, and to be honest, this is not that critical. What's critical is that you keep it like that. You don't change it every week, okay? But I'm using 500 bars. Not sure about you, Joe. And also the other thing that could happen is the market data provider. In my case here, I'm using QuadStream Media. For the ones of you using TradeStation, at times you may get slightly different stats or values because it's a different market data provider, okay? Even though the data is coming from the exchange, is supposed to be the same. There is always, issues with data consistency, and that's what it is, okay? If you think about it, it's millions and millions and millions of transactions registered in a database, so it's common that some values are off, okay? Okay, so here's Qualcomm, okay? So now, if we were to do this trade, so what can we do here? Okay, well, we have a very similar setup to what we had before. There is an Elliott wave turning point here. So if we were to look at where that market may go if it surpasses this high, so again, all of these falls into the Elliott wave area, and therefore 197.5 or something like that, this would be the location for the target, okay, 197.5, which, it's a much larger move compared to, what we had in the prior case, okay? So looking good, and the question is if we go for 197.5, so how long is it going to take to go there? Okay, and the strategy builder will tell you the target date being January 21st. Okay, January 21st. So we could indeed use January 21st expiration date. We could indeed do that. Okay. At the same time, I would like to revisit the same approach I had before. And for me to revisit the same approach I had before, I will want to take a look at the various expiration dates available starting January 21st. Also, I would like to know a bit more about those skews to try to find an optimal, very productive setup. Calls and puts both. Okay, so what do we have here? What do we have here? So obviously, as you can see, the blue ones and the pink and the green one are looking like the calls are becoming expensive very fast. I'm not in love with that. Remember, I want to see a line going down. Okay. Now the orange one seems to be the line is going down and then it's kind of going flat or a bit up. So in any case, out of all those particular lines, seems to me that the orange is probably the most optimal from the point of view of getting puts which are as expensive as possible and calls which are as cheap as possible. That's more efficient than the blue lines and is indeed more efficient than the green and the pink. Okay, so we're going to be focusing on the orange one, which the orange one is February 18. So in this case, the trade is going to be planned with February 18. And I'm not sure it's going to work very well because, as you can see, the calls are becoming expensive, going back up. This is like a classical volatility smile. And that's not going to help the type of trade I'm trying to plan. So we may end up actually using the strategy builder as we did with the prior trade. We'll see. Let's take a look. So where is my UFO? My UFO there is 183, 184. Strike price increments are 5 at a time. Okay, strike price increments are 5 at a time. So if I was to do this, it's going to be 185, 180. Okay, so what if I do sell the 185 and buy the 180? Okay, so what happens if I do that? That creates a credit of 2 something, and that is not going to work well because the calls are way too expensive on the upside. Take a look. If I need to buy a call which is $2 something, that pushes me up to the 220, where my target is I think I said 197. So 220 is going to be way out of the money. So again, if I do it, if I add it, okay, my delta is going to be a low delta and it's not going to work well. It's exactly the same story that we had before, but in this case it's worse because the calls are becoming more expensive, as you saw with that volatility smile shape. So then we're going to keep it very simple. 197.5, right click. We're going to send this to the strategy builder, see what's available. And we are about to decide if we take this trade or not and how. And if we do it, great. And if we don't do it, that's it. It's part of trading. Sometimes we discard trades. So notice that the trades that give the best performance are the bull call spreads, around 50%, but also around 50%, we also have a bull put. And I guess I don't need to repeat myself based on what we said before. So doing the bull put could make and does make a lot of sense, isn't it? Let me see that though, because I mean, indeed, the bull put spread here. Let me load a few risk graphs. So the bull put spread that creates the best performance, which is in the money, has a break-even point at 191. Okay, that means that the current price is 185.62, right? This is the current price of the stock. And for you to make money, you need to reach at least 191.97. Okay, so of course the target is 197, so 191 is relatively close, but you do need that stock to travel by $6. Okay, what if I were to get the one with the least amount of performance? What would happen with that? So if I do this one, The break-even point is 187, meaning that as long as the stock rallies by $2, that should be fairly easy to do because it's a $185 stock. So as long as you get that, then that's it. You would be in a good position to be in profit. And if that was the case, your profit is 262, which is the credit collected, versus 237, which is the risk of the trade. Okay, so again, it's almost copy paste from what we saw earlier when it comes to the type of trade and the setup and everything else. I guess it makes sense because the S&P has been like rallying and then boring for like 3 days in a row. So most stocks are setting themselves up with a similar chart pattern, and therefore the trade that we are basically finding is similar. But again, in this case, not using the call is better because the calls are becoming too expensive. So using the put side is better, and just to have a little bit of a more efficient break-even point. So the point would be to do what I just suggested here. Okay, so let's go ahead and plan on executing this trade. I'll float this window, go back to TOS so we can enter Qualcomm using 18th of February. And again, the strikes, let's not make a mistake here. The strikes are sell the 190, sell the 190, buy the 185. So selling the 190 and buying the 185. This is providing, this is February 18, correct. Selling the 190, yes. Buying the 185, yes. Current credit is 258. The one that shows here is 260. Let's try the 260. I would say probably we won't get filled. And I may need to rectify this. Yeah, doesn't seem we're being filled right away since we are reaching the top of the hour. So I'm just going to speed up the adjustment of the price. You guys take a bit more time than me, so ideally you can get filled at a better price. Not yet. And do it again, 250. Okay, I just got filled at 250. Okay, so this is a risk of 250 in exchange for a reward of 250. So this trade starts as 1-to-1, even though later we're going to be working on it and improving its performance. So let's document it. The 185 we paid 10.05, and the 190 got us paid 12.55. Okay, so copy, position to the clipboard, and we go back to top. And we're gonna go to the positions, and we have another one there with Qualcomm, which is our other bull put spread, in the money bull put spread, directional bull put spread with a different amount of deltas, and ready to make money in that direction. My friends, I just have one thing to do and we'll be concluding the last session of the year. Here we go. Not like that. Here we go, like that. Yes. Okay, I just wanted to add this line so we can track the trade in future sessions. You got filled at 258, Christian. Wonderful, wonderful, perfect, my friends. Look, what a year 2021, isn't it? So many things have happened. We increased the amount of sessions that we do. We launched Top. We had the pioneers. Wow, so many things, and I cannot believe that the year is basically over, even though it is. Happy New Year, everybody, guys! And again, you guys make my day every time we have a live session. I love this so much, and I love receiving your messages. Interacting with you guys. I feel your passion, and yeah, it's really a pleasure. So you guys keep up the good work. Let's have a good end of the year and even better beginning of the next year. into 2022. Hopefully, as well, the world will be a bit less crazy with uncertainty and COVID cases, because there are many people, especially in Europe at this time, with cases, and that's obviously very serious for many families. So hopefully the world will be just a bit easier into next year, and we'll be here, my friends. Looking forward to continue what we do, and we have many plans for next year as well of things that we'll do as a company as well. So looking forward to share and to show you everything that we are planning and doing, guys. So thank you so much, and your words mean a lot, everyone. Christian, Joe, Joanne, Mark, um, everybody, guys. Thank you so much. I'll let you go now, okay? Of course, Mark. My pleasure. My pleasure. My pleasure. Take care, everybody. Happy New Year. Bye bye. See you next year.